Three categories of insurance law. First, business of insurance. These laws affect the requirements for companies wishing to operate the insurance industry. These laws can vary widely from state to state. And also, these laws also govern licensing insurance companies, regulating who insurance companies can turn away from coverage, and the types of insurance a company must offer in a jurisdiction if it wishes to offer other policies, and many others. Next, number 2, content of insurance policies. Prevent predatory practices that would essentially let insurers offer worthless or diminished value policies. They also prevent insurers from misleading clauses and titles on policies that would allow an unsophisticated buyer to believe that they are buying one type of insurance but receive another. And the last is number 3, handling of claims. So these laws affect how insurance companies must respond when a claim is made. They prevent insurance companies from denying claims unreasonably. They also prevent insurance companies, in certain instances, from canceling policies simply for making claims. They also affect how insurers can make claims and what happens if someone attempts to make a fraudulent claim. The next topic would have to be the principles of insurance law, specifically 7 principles. So the first is the principle of utmost good faith. So the fundamental principle is that both the parties in an insurance contract should act in good faith towards each other. Example, they must provide clear and concise information related to the terms and conditions of the contract. The insured must provide all the information related to the subject matter, and the insurer must give precise details regarding the contract. Next, number 2, the principle of proximate cause. This is also called the principle of causa proxima, or the nearest cause. The principle applies when the loss is the result of 2 or more causes. The insurance company will find the nearest cause of loss to the property. If the proximate cause is the one in which the property is insured, then the company must pay compensation. If it is not a cause the property is insured against, then no payment will be made by the insured. Next, number 3, the principle of insurable interest. This principle says that the individual or the insured must have an insurable interest in the subject matter. Insurable interest means that the subject matter for which the individual enters the insurance contract must provide some financial gain to the insured and also lead to a financial loss if there is any damage, destruction, or loss. Next, number 4, the principle of indemnity. This principle says that insurance is done only for the coverage of the loss. Hence, insured must not or should not make any profit from the insurance contract. In other words, the insured should be compensated the amount equal to the actual loss and not the amount exceeding the loss. Number 5, the principle of subrogation. Subrogation means one party stands in for another. As per this principle, after the insured, example the individual, has been compensated for the incurred loss to him on the subject matter that was insured, the right of the ownership of that property goes to the insurer, example the company. Subrogation gives the right to the insurance company to claim the amount of loss from the third party responsible for the same. Next is number 6, the principle of contribution. Contribution principle applies when the insured takes more than one insurance policy for the same subject matter. It states the same thing as in principle of indemnity. Example, the insured cannot make a profit by claiming the loss of one subject matter from different policies or companies. And last, number 7, the principle of loss minimization. The principle says that as an owner, it is obligatory on the part of the insurer to take necessary steps to minimize the loss to the insured property. The principle does not allow the owner to be irresponsible or negligent just because the subject matter is insured.